Hi everybody, good Friday morning. We're on the floor of the New York Stock Exchange with Matthew Cheslock, an equity trader at Virtu Financial. All right, Matthew, stocks are down. Reports of President Trump doubling steel and aluminum tariffs on Turkey. So here's evidence that the markets are still worried about trade.
Yeah, it's not such a good morning, Friday morning to start, at least if you're from a Turkey standpoint. But, we saw the news leak out of Turkey yesterday. That took the market to the lows of the day yesterday, and we're continuing that follow through today. We saw the speech this morning from their president. We didn't get a whole lot of confidence out of that speech either. The market actually went lower when we were hoping for maybe we get some ideas of what they could do as far as economic reform, what their central bank may be able to provide. In fact, we didn't get any of that, and the market is really around the lows of the morning.
But it's interesting to see such a market reaction to tensions with Turkey versus some of the rhetoric we heard earlier this week with China. You would think China is the more important economic factor in this equation than Turkey.
Yeah, you look at the GDP of Turkey, it's about 860 billion. That's not even the market cap of Apple, as we were talking earlier in the week when Apple hit $1 trillion. So it is funny that you mentioned that, but I think China's a bigger picture. We're going to have this is going to be a long, drawn-out process, and that's why this market has not sold off on the Turkey news. This is more of a contagion based in Europe, which is a new front that we really don't need right now if you're talking about trade wars, with Canada, Mexico, China, and now we have one with Europe.
How much of this decline is also to do with lower volumes? We're wrapping up earnings season. August is a tricky month for the markets.
Yeah, we expect some volatility when the markets are slow like this. You're going to see some one-sided moves. We've seen a lot of stocks after their earnings move more than 10%. That's a big number. So you have to, if you're a trader, you have to account for that. You have to be prepared for it, and you may not want to establish that big position that you would hope for because you may not be able to get out of it on the back end.
The markets don't seem to be worried about a somewhat hot CPI, Consumer Price Index report this morning, showing the CPI up 0.2% in July compared to a 0.1% increase in June. How big of a factor is that right now?
That's not moving the market at all. We saw the PPI yesterday, the same thing, really non-factor. I think there's going to be too many adjustments based on what's going on with the China and the Chinese tariff war that we're going through. So there's too many adjustments that are going to be facing us in the near future to look at this number and really get any kind of traction from it.
And we should point out that the CPI is not the Fed's preferred inflation gauge.
No, I think they have other gauges that they're going to use. But this was a hot number because it's a slow Friday in August. People are going to overemphasize this number, but I don't think this number was outstanding enough either way to move the market.
All right, let's talk about specific stocks. Dropbox shares are getting hit. That's Real Money's stock of the day. You can go to realmoney.com for more on Dropbox. But any reaction to that? Because revenue was up 27% year over year. The COO is leaving.
Yeah, when you have a change like that at the top, it always brings pause to an investor. You saw it act very well going into earnings yesterday, so it's giving back those gains today. So I think it's a case where they just didn't exceed expectations. Maybe they met expectations, but they didn't exceed them, and people are taking pause today.
And what is, maybe what we're seeing from Dropbox reveal about the rest of the tech sector, which has actually done quite well so far in August?
Yeah, we had a slow earnings season for the tech sector. We saw some stocks get really hammered. They've bounced back nicely, but I think you're going to have to start readjusting your valuation levels of these. And you can't expect 30 to 40% growth year over year, quarter to quarter. You may have to ratchet that down a little bit and still have numbers that are quite good.
Although you look at a stock like Roku, 45% revenue growth. It's at $56, $57 a share.
Yeah, Roku's an amazing story right now. Yesterday was phenomenal action after their earnings, but is that growth sustainable? I don't know, I'm not an analyst, but I will say that to expect that quarter over quarter, that's going to be a tough task for them to follow.
So going forward, we have 3 weeks left in August. Where would you be putting money to work right now?
Well, you're going to start to look for some sectors that may be beaten down. Look at oil, right? Everyone talked about oil breaking out, going to $80 to $100 based on the Iran sanctions that we saw. Oil sold off pretty significantly.
We can't even get above 70.
No, I think that's definitely been resistance over the short term here. But if that breaks out and breaks through 70, you could see some of those names really benefit from that move in oil.
Okay, and then what about financials? The 10-year yield has just barely budged. We're still well below 3% in many respects.
Well, that's another one along with oil, right? Financials, we expected the 10-year yield to bust through 3 and financials to go with it. We haven't seen that, but we haven't seen the financials really sell off from their recent gain, which is good, even though the 10-year hasn't moved. So that could be another sector that sees some strong growth if we can get that yield to pop.
Yeah, many of the financial stocks are now positive year to date, whereas a few months ago they were pretty sharply negative.
Yeah, and as you mentioned, the yield hasn't moved at all, so that was going to be the biggest catalyst. So they've been focused on earnings. The earnings were strong, they were good. Now if we get the second half of that, financials will be a place where people will be piling in.
Do we know why the 10-year has been so stubborn, even though the market knows that the Fed wants to raise 2 more times this year?
Maybe it's a defensive play. Maybe people are buying bonds. From an equity standpoint, you look at what it's going to do on the reaction side, and financials are the ones that we look at. So I'm not going to, it'll move, it'll test 3 again, and it'll probably break through 3 in the very near future here. But I don't know if it's going to sharply break out anytime soon.
I mean, look, a lower 10-year yield makes stocks more attractive, right? I mean, it's as simple as that.
Overall, yes, the rest of the market could do very well. Financials may not benefit as much. So, but that's what we've had for so long, and people are anticipating this economy heating up. People are anticipating, a lot of different things. So you just got to be careful, and especially right now in these next month or so when the volumes are light.
Okay, Matthew Cheslock, we'll leave it there. Thank you so much.
My pleasure.